The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A green start to a new quarter, live from Studio 2 here at Bloomberg headquarters in New York. I'm Katie Greifeld.
And I'm Bailey Lipschultz. We're kicking you off to the closing bells here in the U.S. with green on the screen for equities, but well off of our session highs right now. S&P 500, as you can see, up about 40 points. Really seeing a lot of strength coming back into vogue for the NASDAQ 100. Mag 7 names getting quite a lift. A big driver of that has been the drop that we've seen in oil. Brent crude, though, still above $100 a barrel. And Katie, looking at that two-year yield, essentially unch on the day at 3.8%. It's been an interesting start to the quarter, again, with investors dipping back into some of those risky assets as headlines fly around the ongoing war in Iran.
Absolutely. And when it comes at least to equities, it's the first day of a second quarter, and it's off to a positive start as optimism continues about a conclusion to the war in the Middle East. You see major gains in U.S. travel, mining, and chip stocks boosting the major averages after the president, who will address the nation tonight, said that Iran has asked for a ceasefire. Now, Wall Street seeming to ignore reports from Iranian state TV that says that those claims are baseless. Meanwhile, labor market data out today foreshadowing what could be a positive jobs report coming this Friday. The latest numbers from ADP showing U.S. companies added more jobs than expected last month, indicating perhaps that the market is stabilizing, though remaining in a low hire, low fire state. And if the labor market isn't enough to juice markets this year, a massive IPO from SpaceX might just do the trick. Elon Musk's company is one step closer to delivering the biggest listing ever, with SpaceX confidentially filing for its IPO earlier today. Now, it could seek a valuation of more than $1.75 trillion. That news coinciding on the same day that the U.S. is set to go to the moon for the first time in decades. Big day for space, Bailey, who, of course, broke that SpaceX IPO news.
Big day for space, Katie. And one thing that IPO candidates are keeping a close eye on is the VIX. We're back below 30, but IPO bankers really want to see this number closer to 20. As we look at the market continuing to fold out, the ebbs and flows around headlines for Iran, you see that big spike that we saw over the last few weeks. Again, pales in comparison to what we saw back in the aftermath of Tariff Day in early April about a year ago, Katie. But it certainly seems like volatility coming back down to more acceptable levels for equity investors, and that's why we're seeing some of these stocks rallying today.
Well, let's kick things off with Rich Weiss. He is Senior Vice President and Chief Investment Officer of Multi-Asset Strategies for American Century Investments. Rich, it's great to have you with us. I mean, you take a look at this market, and it just seems that every single headline is redefining where risk appetite currently lays. And when you think about all the different cross currents, what we're seeing on the geopolitical scale to what we're seeing from the economic data that's still coming through pretty much unscathed by the war in Iran, what do you make of it all?
Well, today in particular, and to your point, clearly we had some good news on the labor market front and retail sales. We're hopeful for better news on Friday to come out economically. And of course, there's always the hope that the speech tonight from the president is good news on the conflict in the Middle East. And I'm not sure we're going to be pulling out quite yet, or the Strait of Hormuz is going to be opening up anytime soon. But there's that hope there, springing eternal for the markets. But for the time being, inflation is a problem. And even if the Strait were to open up tomorrow, I think the market needs to understand that inflation's here for at least the foreseeable future, right? Because even if they did open up the Strait, that would take a couple of weeks. Even if the president did back out, restarting production and exports will take months, and then rebuilding all the infrastructure that was destroyed, that could take years. So inflation is the problem of the day, which then leads potentially to so-called demand destruction. So we're a little more cautious right now than maybe the market's indicating today.
Well, talk to us about what that caution looks like in the context of how, you would protect against possible sustained inflation here from what we've already seen already. I mean, how does that translate through into equities? How does that translate through into fixed income?
Right. Well, we see inflation translating into more demand destruction. The report on retail sales was pre-war, right? So and the latest estimates I saw from the economists is roughly speaking, every $10 move in oil prices up can tick down real GDP by 0.1%. So we're down a 0.5%, give or take, here in real GDP this year. And in fact, the blue chip consensus of economists is rapidly ratcheting down their expectations for real growth this year from where it was at the beginning of the year, which was 2.6, and we're easily coming down to around the 2% margin. Still healthy real growth, but much less than formerly anticipated. So with that coming around the corner, it's possible for equities to eke out a decent return this year after all, but we see interest rates coming down. We see bonds as potentially the better play here in the near term.
Rich, how do you think about that? You mentioned interest rates, the expectations for the Fed's action. Obviously, the White House has been adamant about getting rates lower. But when you're looking at a market backdrop and an economic backdrop where people are throwing around still the risk of stagflation and what that can mean for consumers.
Oh, for me, it's a foregone conclusion that the Fed is going to be lowering rates once Kevin Warsh comes on stream. Maybe not right away, but he'll move the dial there. And so I think Fed funds futures, which are still at this point, a toss-up between a rate and a hike this summer. I think that's going to move firmly into the rate cut, at least hold, but rate cut territory. And we'll get 1 or 2 rate cuts anticipated again later this year. Add to that, I think you all saw Secretary of the Treasury Bessent. He recently indicated or said outright that the U.S. is insolvent, which I find interesting because we can always print money. It's not as if we can't pay our bills. Not recommending we do, of course, given how inflationary that would be. But that he went on to say that we need growth in the U.S. And that, I believe, is code for we're going to be lowering interest rates, not only short-term rates by the Fed, but also potentially yield curve control. That is the Treasury coming in to bring down longer-term rates. And I think that's where this is headed. So whether the war in the Middle East ends tomorrow, whether or not we have demand destruction, I think the Fed and the Treasury are going to be in a coordinated effort to proceed with what the administration has unabashedly indicated it wants to do, which is to bring down rates, spur the economy, and of course, reduce the debt burden, the interest rate and the debt burden and the federal deficit. That's their main goal, I believe.
Yeah, Rich, but in just about 30 seconds, then, how do you think about where equities can end up if we are in an environment where the U.S. government is doing everything they can to try to pull those levers?
I think then equities can have a decent year. You pull down interest rates. We still have strong retail sales, a labor market that appears to be okay. So relatively healthy economic growth. Earnings have not been significantly affected yet. And if rates come down, that could be a nice recipe for a bullish end to 2026, even though we started off in the wrong foot.
All right, Rich, great to get some time with you. That is Rich Weiss. He is Senior Vice President and Chief Investment Officer of Multi-Asset Strategies for American Century Investments, helping us to kick off the show. And coming up, a closer look at the back and forth on an Iranian ceasefire and what the president may say in his address tonight with Michael Ratney, Senior Advisor at Center for Strategic and International Studies and a former U.S. ambassador to Saudi Arabia. This is The Close on Bloomberg.
President Trump saying a ceasefire with Iran is only possible when the Strait of Hormuz reopens. Markets nevertheless pushing higher, as you can see, brushing off mixed messages on the ongoing war in the Middle East. All eyes now shift to President Trump's 9 p.m. Eastern address to the nation. Joining us live is Michael Ratney, Senior Advisor at the Center for Strategic and International Studies and the former U.S. Ambassador to Saudi Arabia. Michael, thanks for joining us. Obviously, a lot of back and forth on what the next steps could be. I want to jump a little bit further. If we do see the U.S. military pull back without reopening the strait, is that, in your mind, a failure?
It could be a disaster, actually. What President Trump has signaled in the last day or so is that it's not our problem. The Strait of Hormuz is Europe's problem or Asia's problem because they're the ones who buy oil that passes through the Strait of Hormuz. But he seems to neglect the fact that oil is priced globally, and just because we produce it in the United States doesn't mean the impact of a continued closure is going to have an impact on the global economy and oil prices, even for Americans.
Well, one of the questions that has come up in conversations with investors and advisors has been the potential knock-on effects if America ultimately could be facing some of the blame for inflation globally. Obviously, we've been tracking oil prices and energy prices in other regions in the world. At some point, does that impact the path forward for the Trump administration in your mind?
I think the economic impact, particularly domestically, more domestically than internationally, really weighs heavily on Trump's calculus. I think it's one of the reasons why he watches the stock market so carefully. He watches oil prices so carefully. That seems to be the gauge and the thing that's pushing him and has been pushing him for a couple of weeks now to want to figure out a way to end the war. I think it would have been easier before Iran closed the Strait of Hormuz, because that now becomes the principal factor having a global economic impact, but the one over which we seem to have the least control.
Well, that's what I was going to ask, Michael, is, how big of a point of leverage is the fact that Iran is pretty much controlling the Strait of Hormuz and pretty much keeping it virtually closed at this point? You think about all this back and forth, the different messaging that we're seeing on the U.S. side. It all seems to hinge, to an extent, on the Strait, though.
Exactly. President Trump keeps trying to suggest that it's not a big deal, and since it's not a big deal, somebody else should take care of it other than the United States. The Iranians have a tremendous amount of leverage, partly because it's not that hard to keep the Strait of Hormuz closed. We sank the Navy, but you never needed the Navy to keep it closed. All they need is threats against ships by drones or rockets, or dissuading insurance companies in London from covering the tankers or cargo vessels. It's pretty easy to keep it closed, and as long as it's closed, you have this kind of sword of Damocles over the entire region and the economies of the Gulf and the global economy that depends on oil. So to walk away from it really would damn the credibility of the United States and pose a long-standing threat to global economic conditions.
And I do wonder, where the UAE, where some of the Gulf countries come in here. There is still the hope of diplomacy, but also we know that the UAE is also among the Gulf countries who are asking the UN to basically be able to use force to help reopen the strait here.
Right. I think the UAE, Saudi, I think all the Gulf countries in a way are confounded. This is their worst scenario. I don't think they ever wanted the war to start, because I think they predicted a lot of these downside risks, including the threats to their own infrastructure, closure of the strait. But now that it's ongoing, and now that Iran has closed the Strait of Hormuz, I think they all find it just unacceptable for the U.S. or anybody else just to walk away. And different countries have different reactions. I think the UAE has signaled that they're willing to get more involved, both diplomatically and militarily. I think Saudi is cautious on that point because they really fear an escalation which could affect their energy infrastructure, desalination facilities, and so forth badly. So it's true, the UAE is pursuing this resolution at the UN, which could authorize force. I think they and the Saudis and others are supportive of mediation efforts. Pakistan has gotten involved. As I understand it, the Pakistanis are consulting with the Chinese, and they issued a statement together. It shows diplomatically they're bringing some heavy hitters into the equation. The question is just what is the basic outlines of a near-term deal? I don't think the U.S. or Iran can settle everything, all the differences between them, but if there's something like a de-escalation and ceasefire in exchange for the Strait of Hormuz opening again, I think at least then we're on a good path.
Yeah, Michael, just quickly here, wondering what you would look for when we do hear from President Trump this evening, and things that investors should be keeping in mind or keeping an eye on, just given we are in a shortened trading week here in the U.S.
Right. I think he's going to want to signal that he has a plan and that he intends to get out. I don't know that what he says is going to be terribly satisfying, because he's been signaling that he wants to get out and that he has a plan for many, many days now. And both the timeline and the objectives keep shifting. But I think he does want to convey that this war is in everybody's interest, that he has a plan, that he doesn't intend to stay in Iran forever. I think the thing to watch tonight, though, is what does he say exactly about the Strait of Hormuz? To what degree does the United States bear any responsibility for having it closed and efforts to try to open it? And if not, whose responsibility is it? Because we can claim the war is over, we can claim we're in negotiations, but as long as that is hanging over our heads, it's a little bit hard just to walk away.
All right, Michael, really appreciate your time and your perspective as we await that address. That is Michael Ratney. He is senior advisor over at CSIS and former U.S. ambassador to Saudi Arabia. Now, coming up, Novo's new head of U.S. business lays out the path forward for the pharma giant as GLP-1s sweep the domestic market. That conversation up next. This is The Close. Well, it has been a wild day for shares of Novo Nordisk. You can see fluctuating right now as Eli Lilly soars on its weight loss pill, winning U.S. approval. I sat down with Jamey Millar. He is Novo's new head of U.S. operations on the heels of that headline. Here's part of our conversation.
Of course, we were expecting approval for Lilly's product. We're proud to have pioneered this category, both with the injectable form being the first to introduce Wegovy injectable back in 2021, and then being the first to introduce an oral pill form version of Wegovy. So we're excited about, our benefits for consumers that are in search of medicine for weight loss. The Wegovy pill is highly efficacious. It is 17% weight loss observed with the pill, which is injectable type efficacy. Wegovy is the only peptide in a pill. The competitive product is not Zepbound in a pill. And the tolerability profile is really strong. Wegovy pill, we see about 2% of patients discontinue due to adverse events. So we're exceedingly proud to have pioneered this category and look forward to sustaining the trajectory that we've seen since launch with Wegovy pill.
Well, what we've seen so far, clearly strong demand. So I just wonder how you keep that momentum going, especially when it comes to your marketing efforts, for example. How aggressive do you plan to be there?
Yeah, we'll continue to communicate our strengths, our benefits. That's efficacy, tolerability, simplicity in terms of the administration. It's just a simple sip and go. Sip with a glass of water in the morning, wait 30 minutes before you eat. We're focused on use, users, and usage. The use that we've seen since launch is unprecedented in terms of the volume and receptivity from patients for Wegovy pill. On the user standpoint, we've seen more prescribers come over to Wegovy as a consequence of the pill format, and more patients, a lot of the patients experiencing Wegovy pill had not been on a GLP-1 previously. And then on the usage part, that's the shape of the use, we're focused on reimbursed volume and self-pay volume. We're focused on how patients move through the titratable doses up to the maximum dose of 25 milligrams. And then also focused on the duration of their usage, the adherence. We want patients to be able to start with Wegovy and stay with Wegovy, which is one of the reasons we announced yesterday the subscription model that encourages patients to stay on therapy over time and realize significant savings. Consumers continue to choose medicines based on efficacy. We have fantastic efficacy with Wegovy pill, tolerability, fantastic tolerability, and we've made the product affordable, accessible, and predictable in terms of their out-of-pocket spend.
Well, let's talk a little bit about prices here, because Lilly's pill, the lowest doses will cost $149 a month for patients who are paying in cash. And my understanding is that your pill has pretty much exactly the same pricing there. So I wonder if that's a lever that you can pull. Do you have any plans or any thoughts about lowering prices from here?
Well, first of all, I'd say imitation is the best form of flattery. So interesting that they've matched, our initial pricing points. But again, the subscription model is unique. It's a first of its kind in the industry. The ability to sign up for a 3-month, a 6-month, or a 12-month subscription and have appreciable savings over that time period. For patients on the injectable form, if they sign up for a 12-month subscription, they can save up to $1,200 a year. And this is significant savings for a category that has become more consumer-centric, as we've seen.
Well, the subscription model is really interesting, especially when you combine it with, Novo making peace with HIMSS. Obviously, you work with other telehealth platforms as well. And when it comes to the cash pay consumer, which it seems like, again, those sort of models and partnerships would be aiming for, I mean, what potential are there for other avenues, other innovative ways to reach them?
Mm-hmm. Yeah, thank you for the question. Our initial wave for the subscription model will go through Ro, Weight Watchers, and LifeMD, followed in a second wave by Hims and Hers, Sesame, and others. And ultimately, we'll look to execute this dynamic pricing model through our own NovaCare pharmacy as well. So we see it expanding. To your question, this is a unique situation with this category. Traditionally, the patient, the consumer, is the end user of a medicine, but generally a practitioner, a healthcare provider would be the decision maker, and the PBM or health plan would be the funder, the budget holder. In this category, the consumer is uniquely the end user, the budget holder, and the decision maker. And our approach with a subscription model, with limited time offers, to encourage affordability and predictability is really meeting the consumer where they are with this category.
And my thanks to Jamey Millar. He is Executive Vice President of U.S. Operations over at Novo Nordisk. Really interesting time to hold that conversation, of course. Eli Lilly getting the FDA nod for their own obesity pill. Eli Lilly had about a 4-month head start. That is set to close, but certainly it's been interesting to watch that sort of fierce competition develop over the past few years. But how about these equity markets, Billy Lipschul?
How about them? I just want to go ahead and say Novo Nordisk ADRs at their peak, down about 75% from there. So tough sledding going forward. But this is a market that at least seemingly we're a bit more optimistic on the end of war in Iran, seemingly. And we are continuing to track at least some flows towards some of the big tech names, which is kind of stands opposite of what we've been talking about earlier in the week.
Yeah, it's been interesting to see tech really bear the brunt of the selling pressure that we've seen over the past 4 weeks or so. I will say that even though we are higher on the S&P 500, we're below our session highs. We're higher by as much as 1.2% today, still higher by about 0.8%, but some of that enthusiasm cooling. But coming up next, we're talking all about the economy. We'll do that with former Boston Fed President Eric Rosengren standing by. This is The Close on Bloomberg. It's just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld.
And I'm Bailey Lipschultz.
And we are keeping a close eye on this labor market because Friday's jobs report expected to show that non-farm payrolls rebounded in March after a steep drop in February. Private sector payrolls, as tracked by ADP, seem to reinforce the job market's low hire, low fire mode this morning. And I'm pleased to say we're joined live now by former Boston Fed President Eric Rosengren to discuss it all. Fantastic to have you with us. So there is that market mantra out there that you don't trade ADP because the line between ADP and NFP is fuzzy at best, but still, you take a look at what we've gotten so far this week when it comes to ADP, when it comes to JOLTS, for example. In your view, how does that set us up for the official jobs report that we're getting this Friday?
Well, as you highlight, the data hasn't been that bad. And given that the bombing started at the end of February, the JOLTS data was for February, but the ADP data is actually for March. And I think most people who follow the employment report are expecting it's going to be, as you highlighted, a reasonably good employment report with a snapback in payroll employment and probably no change in unemployment. So that lays pretty good groundwork for the Fed to basically stay on hold.
And I wonder if that's your expectation, that that is what the Fed is going to do for the foreseeable future, because we heard from the Fed's Musalem earlier today, basically saying that the rate we're at right now, we might stay there for a while. And, you add in the different cross currents that we see, where might we land, in your view, when it comes to the coming months?
I think for the coming months, unless something changes quite dramatically, we're not likely to see any change in monetary policy. there's still a great deal of uncertainty about what's going to happen with the Middle East. While the president is going on TV tonight to talk a little bit more about the situation, some of the declarations have been that the war will be ended from the United States perspective in 2 to 3 weeks. But at the same time, we're sending another carrier battle group, and we've been sending troops to the Middle East. So I think there's a great deal of uncertainty. And if we get a situation where we're actually bombing some of the energy infrastructure and some of the civilian infrastructure, that's a very different outcome than if we actually are pulling everything out in a couple of weeks. So I don't think the Fed's going to do anything until it has a little bit more clarity. It has a lot of, those two outcomes are very different, both for the economy and for inflation.
Well, just thinking through even in a best case scenario, to your point, where this is all done and dusted and life goes on as usual a few weeks from now, with the lag in data, when would the Fed even realistically be able to reconsider and view the current state of the economy with a potential path towards making a decision on economic policy?
I think it's still going to be quite a few months because even if oil prices came down, they're not likely to go down to where they were before the shock occurred. The Fed's going to want to see how persistent the inflation impact is. Even if we're not actively fighting, there's still the question of whether the Strait of Hormuz will be open and whether there's a risk premium because people are uncertain whether it could be closed again. So I think on the employment side, as long as the unemployment rate stays roughly where it is, I think the Fed's main concern is going to be focused on inflation. We haven't gotten any inflation reports since the start of the outbreak of the war, but I would expect that it's going to be not just 1 or 2 reports, but they're going to need more to be convinced that this is a shock that they can allow to just pass through.
How do you think about the potential political pressures as it relates to the Fed making a decision, just given the expectations that Warsh will at some point be confirmed?
Yeah, as you point out, Warsh will at some point be confirmed, but right now, Jay Powell, the current chair, has said that he's not leaving until he's no longer under criminal investigation for the construction project at the Fed. And as you're aware, the Senate looks like they're not going to vote on that until that gets clarified. It's not clear to me how quickly that gets done. And that means that the new chair may not be coming in until later in the summer. So I think for now, we're anticipating what the current chair is likely to do rather than the next chair.
It is a pretty wild situation, and I have to imagine unprecedented, that we could be in a situation where, Jerome Powell is no longer the Fed chair, or there hasn't been a new Fed chair confirmed, and that's something, as you say, we couldn't see until late summer. I mean, what does that mean when you think about how the markets might interpret that? Would they just be, taking a look at the Fed votes holistically, taking a look at the messaging from Jerome Powell? I mean, again, you think about this question of Fed credibility. To be without a leader, it poses some real questions there.
Yeah, they'll have a leader since he would still be the chair pro temp. But what they won't have is clarity on when the new chair will come in and how he might change the views of the committee or try to change the views of the committee. As long as inflation is running as high as it is right now, I think it'll be difficult for any chair to significantly reduce interest rates. Even before the oil shock, core PCE inflation was around 3%. And at that rate, you add an oil shock on top of it, and the fact that we've been well above the target of 2% for 5 years, I think the committee is going to want to just wait and be convinced that inflation is not going to be an ongoing concern.
And Eric, just quickly here, is there a world in your view that we could see the Fed, in fact, hike rates?
I think it's pretty unlikely because even if inflation is popping up, they're going to be concerned about whether the oil shock also has an impact on employment over time. So I think in the near term, they're not going to do anything. We'll see what happens 3 or 4 months down the road if the shock is much more severe than it looks like it's going to be right now.
Yeah, a lot going on. Thank you so much to Eric Rosengren. He is the former Boston Fed president. Well, coming up, shares of Coinshares on the move in its first trading day after entering the U.S. market via SPAC. It's today's stock of the hour. Up next, this is The Close on Bloomberg. It's been a volatile ride today for crypto firm Coinshares, which began publicly trading on the Nasdaq after a SPAC deal with Vinehill Capital Investment. The digital asset manager is the largest in Europe and ranks globally alongside BlackRock, Fidelity, and Grayscale. I'm pleased to say the CEO, Jean-Marie Mognetti, joins us now to discuss the company. Thanks so much for joining us. Going public in a backdrop where we've seen, or at least been reporting, that a number of companies in the crypto industry have been slowing processes or pulling out entirely. What gave you excitement to continue going forward with that move?
Well, Coinshares was listed since 2021 in Europe. So, bear markets are for serious company to get listed, and bull market are for hype company to be listed, and we like to be a serious one. And, if anything, the current market backdrop is a perfect pitch book or pitch deck for Coinshares, financial strengths. And, it's not about timing the market. It's really about, is the company ready to be public? And we saw the company was now ready to be public, so it was time to go.
And talk us through the decision to go, the route of a SPAC versus, a more traditional path to the public markets.
Yeah, SPAC have not always a good reputation because they probably have been a bit abused by some capital market advisor. Coinshares uses SPAC as a way to go American. We're a European company. It was a financial engineering vehicle to go to the US. We couldn't just take the company private and release in the US because of the minority protection in Sweden, which imposed us 3 years standstill. And 3 years in crypto is like a decade in the real world. So we wanted to be able to go as quickly as possible. So we effectively did a reverse takeover in a clean shell. And a clean shell in the US is called a SPAC. So it's really technical engineering.
Well, how do you think about the potential volatility, just looking at some of the data? More than 90% of shares were redeemed. That's a common factor of SPACs. So just thinking through lower float, more volatile moves in either direction, just trying to operate a company with that listing.
Yeah, we didn't have real need for capital. We have a very strong financial performance, so we were not in need for extra cash. We were in need of adding new shareholders to our cap table. We raised a pipe as well on the side of it. So in total, there is new money of 65 million coming in the company and new key shareholders. So we're happy with where we are. I'm sure our existing shareholders are happy not to be too diluted as well. And so overall, it's a great situation.
Well, let's talk a little bit about your business. Of course, you're a digital asset manager. We compared you to the likes of BlackRock, Fidelity, Grayscale as well. That is stiff competition. So talk to us. I mean, when you're competing with heavyweights, BlackRock being the world's largest asset manager, I mean, how do you sort of carve out a niche for yourself within that very competitive landscape?
Yeah, well, when it comes to digital assets specifically, which is kind of like the narrative we decided to specialize in. We were not crypto native. We were a financial service company deciding to specialize in digital assets. So there was a real intent there. And when we did this decision, we say, okay, we're not going to be the biggest one. We're not going to be the most disruptive one, but we're going to be the most trustworthy one. And in this industry, trust means a lot. And after that, it's a little bit like, do you go to your GP or do you go to your heart surgeon? If you have a heart issue, you go to your heart surgeon. So we believe digital asset needs a lot of expertise, and it's not just the situation of being a supermarket of digital asset will work. So we bring this kind of added value, added expertise, added knowledge, and confidence in what we do for the last 10 years.
And just thinking through, as you mentioned, maybe a bit of maybe bear market's a little too aggressive, but depending on some metrics, it is that way for digital assets. How do you think about navigating the volatility ahead of a U.S. midterm election that many people in the industry have been having circled for quite some time?
Look, the company has been profitable since 2016. We have been growing year on year, whatever the market cycle we are in. So we have built our company to be resilient and anti-fragile to the cycle. So yes, we make a little bit less money in bear market than in bull market, but we're still a profitable company. And that's very important for us. And so we're going to keep steering our company in that direction with having a very kind of key focus on developing shareholder value and keeping a very close eyes on the return on equity and return on investment.
And so we only have, less than a minute left here, but talk to us through, what the future for Coinshares looks like when it comes to your product lineup. For example, what areas are you exploring right now?
Well, we're trying to be a bit differentiated. So, obviously, we talk about Bitcoin ETF and all this kind of stuff, and especially in the US, it has been completely commoditized. That's why we make a filing last week for a volatility Bitcoin index, effectively, which is the equivalent of the VIX. We believe the CME probably going to launch one day a future market on the volatility. So we want to be the first one to launch there. We're also starting to be much more present in actively asset management, which is a bit different than purely ETF. And finally, we are developing our on-chain capability as well, because we do believe that the future of asset management, the way you consume asset management and the way you distribute it, is happening on-chain. So we want to be present there.
All right, Jean-Marie, great to see you. That is Jean-Marie Mognetti. He is the CEO over at Coinshares, joining us on a day where Bitcoin pretty much unchanged, but we are heading towards a green finish when it comes to the U.S. equity market. We'll take you there with Berkeley Belknap. She is head of U.S. portfolio management for Franklin Templeton Investment Solutions. This is The Close. Just 10 minutes away from that closing bell, Katie Greifeld here with Bailey Lipschultz. You take a look at this equity market. Again, we're off our session highs, Bailey, but certainly plenty of green on that screen.
Plenty of green on the screen. And again, this does come after a really strong session yesterday in the wake of optimism around potentially an end to the war in Iran. As you can see, big tech outperforming with the NASDAQ 100 up 1.2%. And again, Katie, this is all happening with Brent crude still stuck at $100 a barrel, which I think if you talk to most market watchers, maybe they would have expected us to need crude to fall closer to 95 at least to get more optimistic.
Yeah, no, but it seems like this is a market that wants to rally. I see you put the 2-year Treasury yield up there. Tell me about that.
2 years, 10 years, 30 years. I'm a big yields guy. You're a real yield
real yield lady. But you know what? The 2-year Treasury yield tells you a lot about how this market feels about the forward path of Fed expectations. Anyway, let's get to Berkeley Belknap. She is head of U.S. portfolio management for Franklin Templeton Investment Solutions. Berkeley, it's great to have you with us, and I'd love to hear you chime in on this risk appetite that is rebounding in the market, even though we're still hearing different messages when it comes to what the U.S. is saying versus what Iranian state media is saying. It seems like, again, this is a market that wants to go higher.
Absolutely, and thanks for having me today. We've seen indicators both from the technical side that could mean that we're close to a bottom of what we saw last week with the previous 5 weeks of the market being down, the S&P 500. But more than anything, this is all based on the news and the news cycle and the geopolitical playbook, and that is the number one thing that's driving the market. It is more than technical factors. Economic factors with growth, inflation, and policy. And so the market is really hinging on that and the durability of any news that we're going to have, especially tonight with the speech by Trump.
Yeah, it is interesting to see this primetime address coming through. And I mean, with that in mind, what will you be keeping an eye on as the president is speaking? I mean, is this a situation where you're taking a look at what oil is doing, what the bond market is doing, what S&P 500 futures are doing? What is, the most informative asset to watch right now?
It's a great question. I think, the thing we're going to be looking for is more certainty around timing. And, we've seen a huge impact on commodities pricing beyond energy to broader commodities. We've seen really supply side disruption and second order impacts that could adversely impact both growth and inflation. So this isn't just about oil and gas, but also about aluminum, fertilizer, industrial gases. And so, the sooner this conflict ends, the less of an impact we're going to have globally on inflation and growth. And so we want to see some certainty over the timing, but also want to get a better picture of what happens to the Strait of Hormuz. Because if the Strait remains closed or there's a lack of confidence for ships to go through there, that's going to have a really impactful effect on commodity pricing for a long time.
Well, how do you then think about the potential for the U.S. military to pull out of Iran without reopening the Strait of Hormuz? Is that a worst-case scenario, or how do you approach that potential?
It's hard to say what's the best and worst-case scenario, right? If you leave a conflict without resolution, there's the downside, and of that, the lack of resolution and the strait being closed. There's the positive of less destruction going forward. It would be, obviously, the best case scenario would be a shorter term duration of the war and then the straits opening. We haven't seen sort of any indications that NATO is going to come to the aid of the U.S. help with the Strait. So we don't expect to see that issue to be resolved quickly. And with commodity pressures still there, that is the real negative impact, potential impact for inflation going forward.
And just thinking about some of the day-to-day trades and dynamics that we've been tracking, we've got about 5 minutes to the market close today. Tomorrow should be an interesting one. Thursday, holiday shortened week from a U.S. equities perspective. How do you think investors are going to be approaching, obviously, the potential for a very long weekend where a lot can unfold?
Well, we're at the beginning of the quarter, and I'd say that for many investors, typically you're looking at economic factors, growth, inflation, policy, and many look at technical factors. And those often drive assets through a cycle. But right now, we're not looking at a cycle. We're looking at day-to-day activity. And the predominant driver of all returns, whether it's equities, fixed income, gold, other assets, is all geopolitical. And that geopolitical playbook is just much less reliable than those economic factors. So we, like many investors, have reduced risk, and we have a willingness to be nimble given the uncertainty of the day-to-day news. And I think that is probably what you see across many investors, that there's been a reduction in risk being taken. If I'm going to speak out of both sides of my mouth here and say that if there is some very positive news in Trump's speech tonight, then you could see the equity markets take off tomorrow, and you could see bond yields come down as there be a very positive perception of that move. But I think your point about a 4-day or a 3-day market close in the U.S. could lead to some jitters.
Yeah, it's going to be fascinating to see how the trade develops tomorrow, given that we are heading into a 3-day weekend here in the U.S. And given that you take a look at Thursdays and Fridays over the past month, people don't want to hold risk. So this risk rally that we're seeing is going to run right into that. But Berkeley, talk to us a little bit about earnings here. We're just a couple weeks away from earnings really kicking off in earnest. We know that S&P 500 earnings estimates have moved higher. So I wonder how you're weighing that against, a lot of the headwinds that we're talking about right now when it comes to some of those geopolitical headlines.
I'm glad you asked, because it's nice to talk about something positive. And that is that, earnings do look really solid in the U.S. right now, forward earnings, and across many geographies. And if we break down the S&P and we look at the sell-off that we've had recently, it's really been driven entirely by multiple compression rather than a deterioration in earnings. So, as uncertainty rose along with interest rates, this dynamic is not surprising, as investors were just simply not willing to pay for, future earnings streams in an uncertain environment. And we've seen this most clearly in the AI hyperscalers. And of course, this started, 6 months ago with the, concern over a return on invested capital. But we've seen, before yesterday and the rally, the Mag 7 experienced a 1/3 valuation re-rating over the 6 months. So if this war is resolved imminently, the tech sector could again lead without this valuation headwind.
All right, Berkeley, great to get some time with you. That is Berkeley Belknap of Franklin Templeton Investment Solutions. Minutes away from the close, it's a global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Bailey Lipschultz. He's in for Romaine Bostic, and here to help take us through the closing bell, it's Global Simulcast. We're joined now by Carol Massar and Tim Stanovic, bringing together all of our various audiences across the different platforms. And Carol, we're off session highs, but once again, this looks like a market that is really eager to sort of shake off the last month and go higher, even though we're hearing different things when it comes to what the U.S. is saying and what Iranian state media is saying.
Yeah, we just saw President Trump apparently telling ABC that the U.S. is talking with the Speaker of the Iranian Parliament. The back and forth continues, Katie, and we continue to see markets trade that way. Having said that, we're definitely off our best levels of the session, and I think at this point, I think we're all kind of eager to see what President Trump has to say in that evening address tonight.
Yeah, I'm glad you went there, Carol. I know I'm going to be watching that. We're going to have it here on Bloomberg, of course. Bailey, I'm also watching oil and the convergence of WTI and Brent. prices that have over the last few weeks sort of been far apart from one another, now converging. WTI just shy of $100 a barrel, Brent at about $101 a barrel. Both of those down just by about 2%.
But Tim, we're still talking about an oil market that, for the most part, is driving the markets. And again, $100 barrel oil would have been inconceivable a month ago. But here we are, and we're talking about how potentially breaking below that is positive.
Yeah, and it's really interesting to see it not really weighing down the equity market at this moment. But to Bailey's point, $100 a barrel, I mean, these are pretty high absolute levels relative to recent history. If we stay there, how high can the equity market remain? That's a question that we're going to be asking. But the S&P 500, at least on this Wednesday, this April 1st, going to finish about 0.7% higher on the S&P 500. We did break above 6,600 earlier in the session. We've taken back some of those gains. You take a look at the NASDAQ, that's going to finish higher by about 1.2%. The Dow, it's lagging here, higher by about 0.5%. Do with that what you will. The small caps also getting in on the action, but a similar trajectory to the S&P 500, Carol. Started out, saw big session highs, and then faded a little bit heading into the close.
All right, back to the S&P 500 I go. More names, I should say, in the S&P 500 actually higher for this Wednesday session. About 301 to the upside, Bailey, 201 losing ground, and then you've got 2 unchanged.
Yeah, and a lot of the weakness when we look on the sector level, energy and consumer staples. Energy down almost 4% on the day. Big outperformers for the session were communication services, industrials, and materials, all up more than 1%, as was infotech.
All right, let's get to some of the individual gainers, if I may, in today's session. So let's look at some of the stocks that actually were momentum performers as of late. And so take a look. You've got Western Digital, a high flyer last year, up another 10%. You also had Seagate Technology. That was up 8% in today's session. You have Micron up almost 9%. That was another one that gained almost 240% last year. And so just looking through some of the right-through, especially when it comes to something like Western Digital and a few others. I did see a note by Evercore ISI. Actually, it was, I think, Investors Business Daily pointing this out. We believe AI-driven data demand remains fundamentally robust, providing a durable tailwind for the HDD market. Again, this is Evercore ISI writing in a note today. Crucially, the transition from AI training to inference could create a structural opening for HDDs. So nonetheless, I don't know. Momentum players getting some love on this Wednesday. Also getting love, Intel. This too was top in the S&P 500 and the NASDAQ 100, a gain of just shy of 9%. The chipmaker agreed to pay $14.2 billion to buy back half of a plant in Ireland. D.A. Davidson writing that the move bodes well for the company's turnaround story. Transaction financed with cash on hand and the issuance of about $6.5 billion in new debt. It is expected to add to the chipmaker's earnings per share and kind of reflects Intel's growing confidence in its business and its belief that its products can play a bigger role in the boom in spending on AI infrastructure. You probably don't do a deal like that unless you have some confidence about your outlook. And then here's an interesting AI data center play, kind of unexpected. TH is the ticker. The company's Target Hospitality up about 36% there, soaring as much as 43% intraday. It's a $1.2 billion market cap provider of workforce, lodging, and hospitality services, and they secured a multi-year contract worth over $550 million to construct and provide comprehensive facility and hospitality services for a top 5 hyperscalers data center development in North Texas. So I guess they're going to be providing food and lodging.
You got to feed the data centers.
Well, this goes to, we've talked to workplace or housing people, right, who are doing workplace housing where like all this stuff is going on because workers need places to live. Anyway, there you go. Big mover.
You had a lot of gainers to choose from. I had some decliners that stayed in the red all day today, which is great. I do want to start with shares of Nike falling today by more than 15%. Late yesterday, the company gave this gloomy outlook for the year ahead. Revenue expected to decline 2 to 4% in the current quarter. Headwinds include all the stuff that we've talked about for years at this point. Elevated inventories in Europe and the Middle East, weakness in Greater China. Nike CEO Elliott Hill said the direction is clear and the foundation is getting stronger, but acknowledged that parts of the turnaround are taking longer than expected. We got a great story on the Bloomberg. Lily Meyer writing it up about getting a recording of a call that Elliott Hill had with staff yesterday and really trying to rally the troops, given that shares of this company are at lows not seen in more than a decade at this point. So trying to get some excitement and trying to get them to win, and also expressing his own frustration.
Yeah, that was a great piece of reporting. I mean, you have to imagine that, if you're constantly in a state of turnaround and it doesn't seem like it's getting traction, especially when you take a look at the share price, that has to be pretty killer for morale of the employees at that company.
Well, I also, Tim, what shoes were you wearing in October 2014, the last time the stock was this low?
I don't even remember.
Gosh.
It's not good.
What was I?
It was probably
I don't even know. Like what were they?
Adidas?
I don't even know, Bailey. What were the Nikes in 2014?
I'm trying to think. I was probably in college. I was in college.
You were in college.
Katie was also in college. So that was probably. I wore Sperry's and Vans.
That's
Those
enough
are the two things
out of you two. All right, we're going to keep going here. What else do we got on the decliners menu today? How about a little more retail? Let's talk about RH, the company formerly known as Restoration Hardware. Shares fell today by more than 19%. They were down as much as 23%. They closed at their lowest levels going back to April of 2020. Remember what happened then was we were in the demand shock of the COVID pandemic. We were in the depths of that. The company forecast revenue for their first quarter that missed the average analyst estimate. Analysts out and said that the forecast was pressured by execution, supply chain disruptions also. An interesting note from an analyst over at Citi said the company lags peers in the home furnishings industry, and it also reflects a weaker European consumer demand environment. It'll be interesting to hear from more companies as we do get into the next quarter. Like, I don't know, the banks in a couple of weeks about what the demand environment is looking like in the United States. And finally, how about some French fries or potatoes that go to French fries? This is Lamb Weston Holdings. They make frozen French fries from potatoes. Biggest customer?
McDonald's, right? I had McDonald's for lunch today.
There we go.
I tried that art.
Bailey is right.
Dude, it was electric.
Biggest customer is McDonald's.
Nice.
Shares fell to the lowest level going back to 2017. The company's full-year forecast implied weaker than expected fourth quarter performance. They don't have your. Did you get fries with that, Bailey?
I did. I got a medium fry. It was like $5 though, but I will say I tried the Arch. It's a $10 burger.
Yeah.
Worth every penny. It was kind of.
is that the one that the CEO ate?
I was just going to say you should do an Instagram video about it, Bailey.
Next time.
Maybe.
Next time I'll do it, Tim. I'll get you one too.
Thank you.
Beautiful. Tim, I don't know if he would eat an Arch. That doesn't seem like he. I had Chick-fil-A for the third day in a row. No one asked, but I'll tell you. Anyway, let's talk about the bond market and what happened there. It was pretty quiet. Once again, you're seeing fireworks to the upside when it comes to the equity market. Can't say the same for the bond market. It's been kind of nonplussed over the past 2 days, but nevertheless, the 2-year Treasury yield, which Bailey highlighted earlier, rising by about 1 basis point here. But then you take a look at the rest of the curve, and there you go. The 20-year yield now unchanged as well, in addition to the 30-year yield. And I think you can go ahead and call the 10-year Treasury yield unchanged as well, though we are looking at fairly high absolute levels.
Yeah. 2 quarter-pound, 4-ounce, 100% beef patties. That's the Arch. That's a lot of beef.
It's over 1,000 calories, so I kind of felt a little bloated, but I walked around.
They say it's protein heavy.
There's nothing like eating 1,000 calories and then going on air.
Oh, we can't talk about 12 Okay, I guess we can't talk about 12 metric tons of stolen Kit Kat bars.
Speaking of...
Maybe we save it for tomorrow ahead of...
a big meal.
The holiday weekend.
A lot of Kit Kat's going to be eaten over Easter weekend.
And then some. All right, guys, that's a wrap. I'm hungry. I'm really hungry. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Katie and Bailey continuing there over on TV on the close. And, of course, Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow.
And coming up, we take a deeper dive into the market action with Peter Tchir. He is head of macro strategy over at Academy Securities. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Bailey Lipschultz. Starting April, Katie, in the green for U.S. equities, but certainly keeping an eye on what's going on with oil. Oil right now, Brent crude, sitting at $101 a barrel. But as you can see, we saw a rally today in equities, but really being led by big technology companies. NASDAQ 100 up more than 1%, continuing to build on the momentum that we saw yesterday. But obviously, all eyes and ears will be on what President Trump says later this evening when he addresses the nation. Katie, your favorite part of this board is the 2-year. So 3.8%. I'll let you take it from there.
Yeah, it's interesting. You know, that seems to be the part of the curve that you really keep an eye on.
Big fan.
So I'm going to keep my eyes on it. But let's get to some of the day's biggest movers here. I want to highlight Intel, of course, one of the biggest movers in the S&P 500 on a percentage basis to the upside, higher by nearly 9%. I cannot say the same for Nike. What a wipeout when it comes to the shoemaker, down about 15.5%. Remember, they reported earnings yesterday. It was disappointing, especially when it comes to what they're seeing in some of the foreign markets. Again, a big drawdown for their shares. And then Exxon, lower as well. We've seen energy prices drop over the past few days as hopes of a ceasefire or some sort of conclusion grow, and that has been bad news for some of these energy names, which have really been riding high. But let's get to our top story this hour. And like I said, optimism over a wind down of the war, moving stocks higher, and oil down before President Trump's address to the nation later tonight, whereas he is expected to hail his military campaign in Iran as a success and stress that the conclusion of operations may come in 2 to 3 weeks. Now, our next guest says, quote, economic fragility is real. And while he doesn't see a recession for the U.S. right now, it is a possibility. Joining us to discuss further, I'm pleased to say, is Peter Tchir. He is head of macro strategy over at Academy Securities. Peter, it's great to have you with us. And what an interesting moment in time when you think about some of the geopolitical cross currents really making a big impact when it comes to this U.S. equity market. It seems like this is a market that wants to rally, but you think about the conflicting messages that we're getting from the U.S. and Iran. Is this risk appetite resurgence perhaps a little premature?
I think so. I started wanting to fade the market yesterday afternoon. Obviously, the announcement came out that the president's going to speak today, and we rallied further. But I think there's real risk. I think if we talk or somehow declare victory or even say there's 2 to 3 weeks, I think long term that's going to be bad for markets. It's going to potentially lead the Middle East in a very awkward position. I think it's going to be fragile. Honestly, I think when we talk to our geopolitical intelligence group, we're probably supposed to see this through, carry it through, and really fix the region once and for all, where you drive Iran to a point that they become part of the region rather than, the enemy of everyone. I don't know that we have the will to do that, and I don't know that 2 to 3 weeks is long enough. I think when we talk to our generals and admirals that I'm lucky to work with at Academy Securities, 2 to 3 weeks seems very optimistic for what it would take to actually dislodge this regime.
And there's also, the bare fact that the Strait of Hormuz is still virtually closed right now. I mean, if the U.S. were to declare victory and, pull back from the region before reopening the strait or before the strait is reopened, what would that mean eventually for the U.S. equity market when you think about some of the read-through from the energy markets?
Right. I think it's going to drive energy prices higher longer term. You would kind of cede control to this incredibly important, strait to Iran. I don't know how that's good for the region. I think, people would be worried. And when we talk about this, we're very careful to talk. It's not open or closed necessarily. There's an unwillingness of commercial vessels to sail through it. Right. So potentially they could, and you've seen some get through. But I don't see anything changing that willingness to willingness if we back away from this. Right. If we back away from this, I think that leaves it very contentious there. That's going to be problematic for the Gulf states. It will leave Iran in a pretty good position going forward. So it feels to me that, again, market wants to price in, taco trade and this kind of quick win. I think that's probably the wrong approach. I think we should have probably sold this better to the American public, and maybe we'll be surprised tonight, and maybe that's what we'll get, is a much more clear strategy of our final intention and what it takes to really make the world better.
Well, Peter, just a question to go off of that. Is there a point where the knock-on effects of a more closed Strait of Hormuz impacts inflation globally, and all of a sudden multiple nations end up pointing the finger at the U.S.?
Yeah, I think if we leave it, right, it leaves a lot of questions. What did the U.S. do? What did we accomplish? Where are we in terms of being a trustworthy ally, a partner? If you're buying military weapons, do you still want to buy them from U.S. contractors, or do you look elsewhere? So I think it would leave us in a fairly awkward position. I think maybe we can sell it as a win domestically. I don't think it would be sold very well as a win globally. And even tying back to the shipping, and I think, one, we're already seeing this inflation. I think Asia is already at risk of inflation. One of my favorite things, and I probably have to get better hobbies, is going on to Bloomberg, typing NIChemGo, and searching for majeure. So force majeure to me is a cool word, but the amount of companies declaring force majeure because they're not getting the feed products that they need is insane in Asia, right? So you're seeing that. And then the other thing that's come up in some of our recent discussions is a lot of the ships that have been waiting to transit through the strait, you're over 30 days. A lot won't have food left. A lot won't have, gas left, or diesel left. So they may actually have to go back to port to restock. So I think the supply chain for Asia is potentially already fractured pretty good, and we're going to see knock-on effects to the U.S. economy because of that.
But Peter, when we're thinking through some of those knock-on effects, how long do you think it'll take until we actually see that impacting U.S. consumers and suppliers, again, outside of simply going to the pump and saying, all right, it's more than $4 a gallon for gas?
I feel that's probably weeks or months away. You start seeing this. What I'm waiting to see, and so far we have not seen it, but for example, say you make a phone or a product in India, and you have a component that is made out of plastic in India from an Indian plastic manufacturer. If that plastic isn't being made, you don't have that product. And, and people, that doesn't seem like a big deal. I'll always kind of refer to the CEO of Whirlpool, I think, said one of the smartest things during COVID, right? He said, a washing machine that is 99% done is not done. And so I think that's the risk, is you start seeing these little breaks in the supply chain. And domestically, you're starting to see it potentially in food, globally, right? And now apparently Taiwan's not fishing because it's too expensive with diesel. Norway or Denmark's not fishing because it's too expensive. This is going to feed through, no pun intended, the food products very, very quickly. Urea that's used in fertilizer has gone up in cost, right? I've talked to some of the people involved in transportation in the U.S. There is a lot of pressure on them to get fertilizer and ag products to the farms as quickly as possible so they can get through this planting season. So I think there's already risk. And I think kind of like COVID, where we were a little bit, blasé about it until you start seeing it, maybe Wall Street needs to start seeing it.
Yeah, it's going to be fascinating. And to your point, I mean, a lot of these effects, they aren't linear when they compound. It's much more dramatic than that. I do want to quickly talk to you about the bond market, because you think about what we've been seeing so far in Treasury yields, the response has been to move higher. It hasn't been a classic risk-off response. And then you think about what we've seen this week, a pretty muted reaction overall when measured against the equity market. I wonder what you make of the state of play when it comes to the Treasury market right now, because a lot of those traditional sort of relationships, they really haven't held up.
Yeah, so I think there's twofold for me. One is I think people got a little bit carried away with the inflation argument. Yeah, oil's going up. There's going to be these issues. So everyone got very nervous about oil. So I could understand it. I think the recession risk is more real. The other part is you kind of look at this market, and it seems like it's a heat-seeking missile. Every day or week, it's trying to find some new asset class just to punish. And I think a lot of people were long duration. People thought it would be a good hedge. It turned out not to be a good hedge. People had steepeners on. So I think you had a wipe out and kind of washed out on Friday morning. And since then, since Friday morning, when you kind of really had duration sell off across the board, you've actually come back in a little bit. So I think it's going to respond a little bit more like a risk-on, risk-off asset. Having said that, again, every country in the world who holds treasuries probably needs to sell some treasuries to pay for the oil and or to pay for their weapons that they're going to have to buy. So I think there is some real risk to globally yields rising because of the amount of money that's going to be spent both on energy products but also defense spending. So that's going to follow on to the U.S. And again, the other big question is, where do we stand in the world order? Do people want to own as much treasuries as not? I don't think that's part of this selling. I think the selling right now is people need to raise money. But these are all questions about the American brand we're going to be asking for weeks to come.
And certainly we'll get some form of an update in the form of this evening's press conference and speech from President Donald Trump. We've got to leave it there. That is Peter Tchir, the head of macro strategy at Academy Securities. Well, coming up, Neil Atkinson, visiting fellow at the National Center for Energy Analytics, joins us for a check on oil markets as hopes that President Trump will soon declare an end to the war in Iran rises. That's next. This is The Close on Bloomberg. Oil lower on the day as traders await President Trump's address to the nation set for later tonight, where he's expected to announce that military operations in Iran could come to an end in just a few weeks. Joining us now to break it all down is Neil Atkinson. He is a visiting fellow at the National Center for Energy Analytics and former head of oil at the International Energy Agency. Neil, thanks so much for joining us. What do you want to hear, or what would you be looking for as it relates to what President Trump says later this evening?
Clarity. What is the objective? What constitutes the end of the military operations? Because in your introduction, you used the word could was used. We used the phrase a few weeks. What does that mean? Because we're in a situation now, more than a month since the hostilities started. We are no closer to a resolution than we were a couple of weeks ago. The Iranian regime still seems to be pretty firmly entrenched. Meanwhile, as we heard earlier on, the economic fallout around the world from the rising oil prices caused by the interruption to operations through the Strait of Hormuz, those ripples are now spreading far and wide, and we are in the danger, at least, of heading into some form of global recession, and that cannot be good. So I'm waiting to hear what President Trump has to say. It could be anything.
Certainly could be anything on the table. I'm just looking at where we are tracking some of the prices of crude, right around $100 a barrel. Is that, in your mind, some kind of a level where President Trump would be wanting to target keeping crude under? And is there a certain point where you expect there to be more damage from a global economy perspective?
Well, if oil prices start heading back up again after his address tonight, if the market decides that there is no end to this conflict in sight, prices must go back up. I can't see how they wouldn't. And if that is the case, then we start to discuss once again the impact that is having on economies around the world. And for President Trump in particular, what matters to him, of course, most of all, is its impact on American consumers. And we're already seeing prices of gasoline at the pump rise through $4 a gallon. Even more crucially, perhaps, for the health of the American economy, we're seeing the price of diesel rise through $5 a gallon. And that is a very, very dangerous trend if those prices were to edge upwards. So there's an awful lot at stake in terms of what the president has to say tonight.
Absolutely. And you think about where we are when it comes to Brent, still at $100 per barrel, even, with this big drawdown that we've seen over the past couple days, the spread between Brent and WTI coming closer together. If we see the Strait of Hormuz continue to be shut, and we stay around these levels or even higher. So, what levers does the U.S. do? Some of the G7 nations still have to pull at this point, given that Iran is still virtually in control of the Strait.
Well, that is the key question. Iran, to all intents and purposes, has more control over the global oil market than it had before this conflict started. And we're already seeing that some of the G7 countries, obviously not the United States, but European powers, the UK, France, Germany, Italy, and Spain, they are saying to the United States that the situation we are in now is intolerable. This cannot go on, and we will not allow your military assets to either overfly our countries or use bases which are located in our countries. So there's a tremendous amount of pushback going on from countries which are affected by the turmoil caused by the Strait of Hormuz. In the case of the European economies, we're not yet in the same situation that some of the Asian economies already are, where there's rationing, where there's restrictions on driving on certain days of the week, and measures of that type. But Europe is heading in that direction in the next 2 to 3 weeks or so, unless there's a resumption of normal operations in the global oil industry.
All right, Neil, great to get some time with you. Really appreciate your insight here. That is Neil Atkinson. He is former head of oil at the International Energy Agency. A really sobering note to end on. You think about the impact that this is having in Asia, how that could ripple through into Europe and potentially the U.S. Certainly something to keep an eye on as the Strait of Hormuz remains closed. Still head on the close, though, Robert Lightfoot. He is the president of Lockheed Martin Space. He joins the program next, ahead of tonight's NASA launch that will send astronauts to the moon for the first time in 50 years. That conversation coming up next. This is The Close on Bloomberg. NASA astronauts are readying to lift off later tonight as they prepare to board the Lockheed Martin-built Orion capsule for a 10-day journey around the moon, marking humanity's return to the lunar vicinity for the first time in over 50 years. Bloomberg Tech co-host Ed Ludlow, he is on the ground from NASA's Kennedy Space Center in Florida with Robert Lightfoot, the president of Lockheed Martin Space. Ed, take it away.
President of Lockheed Martin Space, but also a former acting administrator of NASA and someone that did almost 3 decades at the agency. This person knows this mission and has sat on both sides of the table. And to summarize Lockheed's place in Artemis, it is Orion.
That's correct. Yep.
You know, the spacecraft.
Yep.
What did you learn from Artemis 1? You know, I think a lot of everyday people coming into this, but also the space industry, the investment community would say, gosh, this thing hasn't flown much. One mission. And what did you learn from that mission?
Yeah, we had a pretty clean flight, really. I think the systems worked as we expected. And I think, you know, the one thing we learned on is the heat shield. We had a little more erosion than we expected on the heat shield, and so we had to spend some time understanding that better.
That was about the materials, right? Yep. The way that materials reacted to the circumstances.
Yeah, and the particular trajectory we brought that vehicle back. Remember, that was a test flight. The intent was to fully test it and stress it as much as we could. So we're going to do a little different trajectory this time, but we also understand better what the cause of that erosion was more than we expected. So
it's not therefore like for like. It's a little apples to oranges because the parameters of Artemis 2 as a mission are different. Mm-hmm. But what changes were made as it relates to Orion from 1 to 2?
I think part of it, the biggest thing was understanding better what the failure mechanism was, right, and how it happened, and could it go further, could it be worse, and so we did all that kind of testing to understand how that worked, and then on top of that, NASA decided we'll change the mission profile, so we have a different trajectory coming into the Earth's atmosphere.
You're at NASA a long time doing spaceflight programs. Mm-hmm. You know, the crew, the astronauts themselves, they have a lot of say in this.
Oh, yeah.
The 3 Americans and 1 Canadian that will hopefully go in a couple of hours' time here from KSC. What's that process like, involving them in the avionics through to the space inside of Orion and the systems that they both manually control and those automated systems as well?
Yeah, I mean, they're the ultimate customer, right? So we have to have the crew involved with everything we do. There are crew members that aren't on the crew that's on the mission that support design reviews and things like that represent the actual crew. So it's a pretty rigorous process to have their voice. We have to have their voice in this process. We want them to be, you know, as comfortable as possible with the systems when they actually use them as we go on this mission.
It's a 10-day mission.
Mm-hmm.
It starts here at Launch Complex 39B. I won't go over every stage, but you know, once they get into that low Earth orbit through to that higher Earth orbit, for 2 days of elliptical orbiting the Earth and then onto the moon, the 10-day process, what's the data that you're gathering from Orion? And I guess what's the mission for the company, right? What's Lockheed's mission in what you hope to achieve?
Yeah, our mission is pretty simple. Have a safe flight and bring these guys home.
Yeah.
It's that simple. And that's what everybody's foresight focused on. This first 12 to 24 hours is going to be testing the systems that we haven't really had the opportunity to test because they had a crew on board. We've loaded them. We've had crew sit in the system, and we let them breathe. Because you got to talk about the big issue, the big thing we're working on now is the crew life support. So think air, water, those kind of activities. Those systems are what we're going to test here. We call it environmental control and life support. Big fancy name for this. That's what we'll do the first 24 hours. If those are working well, we're ready to go because the systems are pretty much the same as we had before.
Artemis 2 is the combined system is out on the pad over our shoulders. Maybe the team in the control room pull up any pictures that we have. You have SLS, the rocket essentially from Boeing, the service module from ESA, companies like Thales, then Orion, Lockheed Martin, and then the launch abort system, Northrop. That's a lot of complicated pieces of hardware from different teams. How do you achieve that?
Well, I think the integration process, we call it systems integration, and the systems integration process that we have at NASA, but also in industry, is pretty well proven. We've done it. We did it with Shuttle. If you go back to Shuttle, the different parts came from different people as well, right? And so there's a large effort around the systems integration, and that's probably where we spend most of our time, making sure requirements pass back and forth and are compatible with each other. So I'm very comfortable with the way we do that process, and NASA leads that, and they lead it in a good way.
We're live on Bloomberg Television and Bloomberg Radio around the world. We're speaking to Robert Lightfoot, president of Lockheed Martin Space, a former acting administrator of NASA, someone that spent 30 years, almost 30 years at the agency. The criticism from the public is that the program is delayed or behind schedule and over budget. I guess is the question to you is, has this been money well spent?
Yeah, I think so. I think what you're going to see from my perspective when I get that question quite often is...
And you do get it often.
I get it a lot. Even when I was at NASA, we would get this question. And I think the key story here, or the key message is, we have to be on the front edge of technology. And the things we're going to do, going back to the moon and actually staying there, are going to create technologies we don't even know about today. They're going to force us to do things differently than we've done in the past. Those will come back here at home, and we'll adapt those just like we did from the Apollo days, things we learned then. So I expect a ton of learning there. The other thing is you've got to be pushing that frontier. It's in our DNA as human beings to explore.
Right.
It really is. And this is what you're going to see. You're going to see, hopefully 30 years from now, there's some kid sitting here having this interview that was inspired by what we're talking about, got into a STEM field and decided this is the career I want to be part of. You can't underestimate the importance of that and what we're going to go do. And then I think the other part is you just got to have the desire to keep pushing the envelope.
What's
and do
the challenge here with deep space as opposed to low Earth orbit activity?
Yeah. Well, I think so. When we're in low Earth orbit, we can be home in 90 minutes. If I have to come home, I'm home in 90 minutes. When we go to the moon, you're talking 3 or 4 days. So your systems have to be that much more robust. They have to be better understood, more resilient, and so you can only imagine if we went to Mars. It even gets you're talking anywhere from 12 to 18 months. So as we build on these building blocks and learning how to do the systems differently and better, your whole goal is to make them more resilient so that you can do these longer duration missions. It's just pretty unforgiving when you get out there if something goes wrong. And so that's the difference.
Robert, my colleague Lauren Grush and I reported a couple of weeks ago that there are 2 proposals on NASA's desk, so to speak, one from Blue Origin, one from SpaceX, that would present some change to future Artemis projects. In very simple terms, the SpaceX part would see Orion launch an SLS to low Earth orbit and combine or dock with Starship in orbit, and Starship push Orion to low lunar orbit or to the moon. What can you tell me about where talks are at with that and why that mechanism is being considered?
Well, the mechanism probably is for speed. Can we get there quicker if we do it that way? That's the one thing. The other thing is it a simpler architecture than what we're doing today, right? Remember, we had the gateway, we had other things. And so NASA has made the decision to kind of change the way they're thinking about that activity. As Orion, the docking mechanism is the same. We've got a common docking mechanism for either option. Now we just need to understand the difference in the flight dynamics that go with that. We were expecting to dock at the moon. Now we're docking back at Earth, and we're going to get pushed. There are some differences that we got to go deal with on the SpaceX side, and we'll have to deal with the same thing on the Blue Origin side. So we're in talks with them. We're understanding their con-ops and what they want to do, the way they're going to operate their vehicle. And our goal is to just make sure we're ready to support that in any way we can.
Robert Lightfoot, president of Lockheed Martin Space, former acting administrator of NASA, and again, almost 3 decades at NASA on spaceflight programs. And we're getting close. There's never certainty, but we're getting close to 6:24 p.m. Eastern Time. Back to you.
All right, our thanks again to Robert Lightfoot, as well as our own Ed Ludlow. He is the co-host of Bloomberg Tech. Looking forward to that launch. As Ed said, not guaranteed, but getting closer and closer. But still ahead on the close, alternative asset managers inching their way closer to tapping trillions in U.S. retirement funds. Harbourvest CEO John Toomey, he joins us with his forecast for the future of private market investing. This is Bloomberg. SpaceX confidentially filing for an IPO. People familiar with the matter tell Bloomberg, and specifically, they tell Bailey Lipschultz. He is sitting to my right, and he was part of the team that helped break this news. So confidentially filing with the SEC here. So that theoretically puts SpaceX on track for that mid-June IPO.
Yes, the timing is still there. Right now, basically how it works is after this filing, the SEC will have a month to review it. They send it back to the lawyers and bankers for SpaceX and basically say, you need to change this language, or hey, how about a bit more detail on that? And while that's playing out, we have been reporting that the so-called testing the waters meetings, more formal interactions with investors will be taking place in the coming weeks, just so investors can really get a grip on A, what this current iteration of SpaceX looks like after that merger with XAI, and B, really what valuation could be justified and how big this raise would be for some of these investors to cut checks to.
Absolutely. So again, this was a confidential filing. What don't we know at this point, which we're hoping to find out when we do get that official filing?
We'll get the official filing, and that'll show audited financials, and in some cases unaudited financials, but it'll really show what numbers investors are going to be using to help benchmark what that valuation could look like. So when we get what we call the public flip, that's when the full documents, after some back and forth with the SEC, will be published. That's when investors really start to pour over those details. That's about a 2-week period, and then the formal marketing can take place. Again, trying to keep an eye on that mid to late June timeframe. Elon Musk's birthday is at the end of June.
Oh, that is actually good to know.
Birthday.
There's also some celestial
That's early June. Yeah, there's the Mars, I think, and Venus are in retrograde. I don't actually know, but that's another thing that has been.
That wouldn't matter to most IPOs, but it does theoretically matter here when you think about the timing that Elon Musk is trying to target. We also don't yet know which exchange they're going to list on, right? Because I have to imagine that that is another piece of jockeying that's happening fiercely right now.
That's a piece of jockeying that's being dealt with. Obviously, we've reported, and some other outlets have reported, that a big sales point from the NASDAQ exchange has been that potential for fast tracking into the NASDAQ 100. They basically cleaned up that issue in the last week, so that would at least be a big step forward for NASDAQ to potentially win that mandate.
Yeah, and Tesla, I believe, is listed on NASDAQ currently as well. It's going to be fascinating to follow this. Bailey Lipschultz all over the case. He's going to keep us updated with SpaceX as we learn more. But the buzz around SpaceX is bringing private markets back to investors' attention. And it's a good moment to refocus on the space as the Department of Labor begins to pave the path forward for alternative assets to enter U.S. retirement portfolios. Joining us live with more is John Toomey. He is the CEO of Harbourvest Partners. John, it's great to have you back with us. And again, we did get that plan, that proposal from the Labor Department when it comes to private credit, when it comes to crypto, some of those sorts of alts, how they might enter in 401k plans. I mean, what did you make of some of the details that we got earlier this week?
I mean, what I saw in the ruling was an opportunity to expand access to millions of Americans who today don't have the ability to invest and save the way a whole generation of Americans before them did in the defined benefit plan era, which invested in diversified private alternatives for decades.
And I am curious, I mean, you think about this moment in public markets or private markets to see these Labor Department proposals come out, this plan come out. I mean, what do you think that the appetite looks like right now when it comes to some of these alternative assets, given all of the scary headlines that we're getting about private credit at this moment?
I mean, I think what you're seeing in private credit is a bit of sentiment overrunning the fundamentals. But when you talk to the plan sponsors, many of whom administer not only the defined benefit plans, which have benefited from diversified private investments for decades, they also oversee defined contribution plans who today that they have been reluctant to bring the benefits to individual savers. And I think the ruling is an important step in that direction.
Well, how are you thinking about, as DZ Bank had put it, private credit posing a chain reaction risk to the U.S.? How does that kind of end up, I guess, working into how you're thinking about the current backdrop?
Yeah, no, I think what we're seeing in private credit is more of a liquidity issue than a fundamental asset value or underlying underwriting issue. And there's certainly individual vehicles or managers that are working through those. But the fundamentals, long-term investing and the alignment with how that fits with retirement savers, when you look at the any long-term return performance of private markets and particularly private equity compared to the public markets, we all know that it enhances the risk-adjusted return, and it's why so many institutional investors entrust 5, 10, 15% of their portfolios into private markets. And I think American workers today deserve the same opportunity.
Well, how do you think about kind of the potential opacity, or at least the conversation around how opaque some of these structures are, and the ability to kind of rewrite something that maybe 3 months ago was viewed as software, but given the pullback we've seen for anything related to SaaS, it's now recategorized hypothetically as healthcare?
Well, I can't comment on what individual managers are doing. What I can say, though, is I think we've all seen the downdraft that's happening in software. And if anything, it amplifies the importance of diversification in investing in equity markets, be that in the public markets, through mutual funds, index funds, or ETFs. And that same will apply to the private markets as well. And there's so much more to the American economy and the global economy than one sector.
And I love this headline from some of our colleagues over at the Bloomberg News print side, basically saying that alternative asset managers, they just notched a key win in their effort to tap into trillions of U.S. retirement dollars. Now comes the hard part. And that, of course, is referring to the uphill fight that they face in sort of trying to attract these assets, John. And I wonder, how you see this developing in terms of, how long it'll take to sort of socialize this idea that, these are assets that are suitable for retirement plans and maybe you want to own them.
Yeah, I mean, I know the headlines are talking about the wins for alternative asset managers. I think the win is really for the American worker who, over time will now have the opportunity to benefit in the same way a whole generation of the prior Americans did. I do think it will start slow. You might begin to see it in target date funds. You eventually will see individual point solutions. But regardless of what the format is that plan sponsors will deliver to their end beneficiaries, I think in every one of those solutions, they all understand the importance of diversification across company and industry and geography, and most importantly, manager, just in the same way millions of Americans invest in their 401ks and mutual funds instead of individual stocks.
And what parallels can you draw here between, when we started to see public market investing really become ubiquitous when it comes to the American retirement landscape? And would you expect this to follow a sort of similar path?
I think it will, although, again, the quantum or the proportion of a portfolio that will be in private assets will actually vary greatly for each plan sponsor, and it will vary depending upon the individual. A retirement saver at 24 might think of it quite differently than a retirement saver in their 50s or 60s. But I would posit you can go back to the press in the 1930s and 40s and 50s, where a lot of the narrative then was we can't let individual investors access or invest in the public equity markets. And I'm kind of hearing that same narrative today on alternatives. And I think we'll look back on the ruling from Monday as a watershed moment in the evolution of the industry for the benefit of the American worker.
Yeah, John, I was just going to ask, in terms of when we look at the longer term, what do the next 12 to 18 months for private credit, in your view, look like?
Yeah, I think for all private markets, credit, equity, infrastructure, I think what you'll see is because many of the plan sponsors also have seen firsthand the benefits of private market investing, they're all eager to find ways to deliver this to a new generation of their workers in their companies. I think you'll take some time for the market to develop the solutions, and it will start slow. But once you'll start to see a bit of traction, it will inspire confidence in other plan sponsors, and I think it will then begin to go fast. And whether that's 1 year or 2 years or 3 years, I think remains to be seen.
All right, John, always great to check in with you. That is John Toomey. He is CEO of Harbourvest Partners. Meanwhile, we take a look at how public markets closed on the day. Another rip-roaring day for the S&P 500. Of course, not exactly what we saw yesterday, that nearly 3% rally for the S&P 500, though it does seem like the big event of today actually comes well after the market closed, Bailey, as we await President Trump's address to the nation at about 9 p.m. tonight.
And it'll certainly be interesting what the president speaks about and kind of framing around any type of actions to give some more certainty to this market. I just want to keep in mind the S&P 500 is still down more than 4% from where it was at the end of February, and crude oil still at $100 a barrel. We were talking about $65 to $67 a barrel.
Yeah.
So a very different backdrop, even if we want to say on an intraday basis or single day basis, there has been green on the screen.
Yeah, absolutely. And I mean, just to think about the March performance that we saw for the S&P 500, even with the 3% rally yesterday to end the month with losses of about 5%, just speaks to sort of really the brutality that we saw in markets. The oil question is an interesting one because even with all of this relief that we're seeing in the equity market, you made the good point that we're still at $100 per barrel. If we stay at these levels, you have to imagine that that is going to start to hit some of the earnings estimates for these S&P 500 companies, even though that seems to be the rallying cry of the bulls right now.
And it's only been an issue for the entire first quarter. We had one of the worst quarters on the S&P 500 since 2022. So it's been AI, uncertainty around private credit, and now another issue with the Iran war.
2022 was an ugly year for the S&P 500, down about 19%. We'll see how 2026 shapes up. We have a long way to go, but still ahead. What investors need to watch for just over the next 24 hours. This is Bloomberg.